the risks that matter, and the opportunities that may be emerging beneath the surface. Joining me today is Sachin Shah, Fund Manager at MK Investment Managers.
Global economic cycles are a reality. There are always certain different reasons. Sometimes it's geopolitical issues, sometimes it's trade war, sometimes there's real war. So all this is a reality. But I think the way we think about it is as an investors, right? That we are investing into businesses, and typically we have seen that over a period of time, businesses tend to grow. One of the very basic things is that invest in quality, invest with reasonable valuations, and I think the third most important thing what the investor can get to the table is always give a little longer time frames, because it's all about how long you are invested, which actually allows you to ride these volatilities. See, again, one very important thing as an investor is to always be an optimist. We've seen this, say, in a very recent past, say when COVID-19 happened, and in the month of March 2020, all the global equity markets were down minus 30%, literally minus 30% in one single month. The point I'm trying to make here is that that there is a lot of resilience in the human race, and there will be always sanity that will prevail over a period of time. But historically we have seen that once you are able to pass this phase, it is much easier to actually grow beyond. Markets are not really just about 1 quarter, 2 quarters, or even maybe few quarters. It's about the next 3 years, 5 years, 7 years. And from that perspective, if somebody is thinking that I want to be an investor for the next 7 years, 10 years, or maybe even longer, then this is definitely a very temporary transitory phase.
In periods of uncertainty, markets often react first and understand later. Over the past few years, investors have had to navigate a series of disruptions, right from trade tensions and inflation shocks to tightening liquidity, and now a phase where geopolitical conflicts are once again influencing the global economic stability. In such environments, the role of a fund manager becomes especially critical, not as someone who predicts every move, but as someone who remains disciplined when markets are volatile, rational when sentiments turn extreme, and focused on the long-term outputs and outcomes rather than short-term noise. At MK Investment Managers, our Fund Manager Views series is an extension of that philosophy, a quarterly conversation where we step back from daily market movements to understand the bigger picture, the risks that matter, and the opportunities that may be emerging beneath the surface. Today, we continue that conversation in context of a world that appears more uncertain, more volatile, and perhaps more complex than it has been in many years. Joining me today is Sachin Shah, Fund Manager at MK Investment Managers. Sachin has spent decades tracking markets across cycles, managing portfolios through periods of expansion as well as disruption, and maintaining a disciplined, research-driven approach to investing. In recent interactions, including his conversation with ET Markets, he has spoken about the importance of staying anchored to first principles, what he often refers to as the golden thumb rule of investing, especially in times when markets test investor conviction the most. Today, we will discuss the changing global environment, the implications of rising volatility, the impact of energy disruptions, how portfolios are being positioned in this phase, and where new opportunities may be emerging. Sachin, welcome and thank you for joining us at the Fund Manager View show.
Sachin, over the last few years, global markets have had to navigate multiple shocks, from trade tensions to monetary tightening, and now an escalation into a real geopolitical conflict. How do you see this space in context of global economic cycles?
So, the global economic cycles are a reality. So, in my career spanning over the last nearly 3 decades, if you just go to see starting from early 2000, when we had this major big, the cycle in terms of very positive growth in the IT services globally across, NASDAQ was one of the biggest, most fancy things. And then there was again that boom and bust which happened. Then we saw something like the global financial crisis. And so, this keeps on happening every few years. And of course, there are always certain different reasons. Sometimes it's geopolitical issues, sometimes it's trade war, sometimes there's real war. So all this is a reality. But I think the way we think about it is as an investors, right? That we are investing into businesses, and typically we have seen that over a period of time, businesses tend to grow. Yes, there will always be a two-step forward, one-step backward kind of a story, but because nothing goes up in a straight line, and which is same very much with the equity investing also. So the way we think about it is that one will always have to factor in this kind of periods in their in their entire investment phase, and have to plan accordingly, right? And how does one plan? So I think one of the very basic things is that invest in quality, invest with reasonable valuations, and I think the third most important thing what the investor can get to the table is always give a little longer time frames, right? Because it's all about how long you are invested, which actually allows you to ride these volatilities. And we have always seen that volatilities actually are the friend of investors, and we really have to figure out how to capitalize this. That's how we actually think about it.
Right, Sachin. Over the last few months, we have moved from talking about trade wars to actually witnessing real military conflicts impacting commodities, currencies, and capital flows. Do you think markets are still behaving as if this is a temporary disturbance when in reality the world may be entering a far more unstable phase?
See again, one very important thing as an investor is to always be an optimist, and we've seen this say in the very recent past. Say when COVID-19 happened, and in the month of March 2020, all the global equity markets were down minus 30%, literally minus 30% in one single month, and it practically felt as if the world is coming to an end. Because the world was absolutely under lockdown. So, but even from there, we all have grown, right? So the point I'm trying to make here is that that there is a lot of resilience in the human race, and there will be always sanity that will prevail over a period of time. There will be this short-term transitory challenges where one starts believing or starts fearing that it's going to be even worse than where we are today. But historically we have seen that once you are able to pass this phase, it is much easier to actually grow beyond, right? So I think the way we really think about it is that markets are not really just about 1 quarter, 2 quarters, or even maybe few quarters. It's about the next 3 years, 5 years, 7 years. And from that perspective, if somebody is thinking that I want to be an investor for the next 7 years, 10 years, or maybe even longer, then this is definitely a very temporary transitory phase, right? The important thing that one has to figure out is that what are you investing in? Those, whether those economies, whether those businesses, are they resilient enough to overcome these challenges? And we have always seen that whenever a company or a business is able to actually overcome this, they emerge even more stronger. So that's how we are actually thinking about the current environment.
Okay, you spoke about resilience. So, investors have operated in a relatively stable global environment, with predictable liquidity and low inflation. Do you think that we are now entering a structurally higher volatility regime?
Well, again, very difficult to predict because, you are in a phase where it will always feel like there is a very high volatility, right? But like as I was mentioning that, uh, if you think even in a much longer horizon, then this again looks like a very small transitory phase. And from that perspective, I'm not overly worried. In fact, as I said, that this kind of volatile periods creates some very good opportunities because your valuations become extremely reasonable. In fact, to a large extent, I would say that many of these blue chips start trading at below their intrinsic values, and which is where the long term investor actually comes into play, and they start chipping in and they start building their blue chip portfolios.
Follow up question. But recent disruptions in crude and energy markets have once again exposed how dependent global growth is still on stable energy supply. So, do you see this as a temporary shock or there is something deeper to it?
No, actually, I think the world has evolved a lot over the last few decades, and particularly in the last decade and a half. Because if you think about it, our dependence on the fossil fuels has actually reduced significantly. Like a case in example, today, just for India as a country, right, the renewable power generation at the base in terms of the capacity level itself is already 50%. But even more important, I think generation of power today, more than 25% is already from renewable sources. So our dependence on fossil fuels has significantly reduced. And as we move ahead, because incremental growth on the renewable side is probably 60, 70, 80%. So I think in the next 5 years, 7 years, 10 years, maybe 50 to 70% of our power requirement will be coming from renewables. You have another very big utility in terms of the autos, which is also very large in terms of your fuel consumption. Again, there the way the technology has evolved with electric vehicles, right? I think it is amazing, right? I mean, it's unbelievable the way the technology has been. Actually, they have like the kind of the batteries that what we saw maybe 10 years back and 15 years back and what it is today, it's a sea change, right? So from that perspective, I think our dependence on fossil fuels has reduced significantly, and I think it will keep on reducing even more as we move ahead.
Right. In an environment where shocks seem to come more frequently, how do you think about building a portfolio that can withstand volatility without compromising long term growth?
Yeah, so clearly, as I think I would just repeat what I said some time back, and basically, there are just two or three things that we need to focus on. Because first is you need to be with businesses which are blue chips, and when I say blue chips, it's essentially quality. And again, quality, the way we think about it is there are two parts to it. One is management quality, and the other is the business quality. As long as we believe the businesses have modes and the managements have their integrity, capability, and the execution prowess. From that perspective, it's easy to identify businesses where one should really be, thinking about investing. I think the other very important part is, and which I think again market is going to offer you in this kind of volatile periods, is the reasonable valuations, right? So again, that's I don't think that's a big challenge in this kind of an environment because a lot of good businesses are available at very very reasonable valuations, and we've seen this time and over. The third thing, which is I think the most important thing, the investors need to supply patience. That is something which is in today's day and age of instant gratification is probably I would say there is a lack of supply of that. But the investor who is ready to supply that a lot of patience and who's ready to ride this challenging environment, believing in equity as an asset class, believing in the track record of the management that they have the resilience to ride this out, and believing in the moat of the business, will actually emerge as a winner. That's how we are thinking about it.
Perfect. Moving to Capital Builder. Capital Builder is viewed in the AIF industry as a stallion for long haul. 13 years, multiple market cycles, and as a lead fund manager, how do you plan to steer Capital Builder in these turbulent times? Also, shed some light on your sectoral weightages and your top stocks currently.
Sure. So the Capital Builder PMS, as you rightly said, has now full 13 years of track record. Over these 13 years, I think the video that we saw earlier of Mr. Hodmarks.
You never know when the environment is going to shift from favorable to unfavorable, and the question is, are you prepared? You know, somebody who, if the market's up 10 and you're up 12 and the market's down 10 and you're down 12, you didn't accomplish anything. The question is, can you make more in the good times than you give back in the bad times? And then I think the other thing that's most important is the cycle and where we stand in it. I don't believe in predicting the future. We never know where we're going. We should understand the present. And where we are in the present, where the market is relative to its cycle, tells you something about the odds that govern the future. Doesn't tell you what's going to happen tomorrow, but I believe that we can only understand, since the world is an uncertain place filled with randomness, we can't know what's going to happen in the future.
Where he mentioned very nicely that if you are on the upside making 12% when the benchmark is making 10%, and on the downside also if you lose 12% when the benchmark is losing 10%, you are essentially not adding any great value to the investors. So what he's trying to say is that if your beta is 1.2 and if you gain plus 20% and if you are down minus 20%, there's no meaning as such. So if you think about it, if you see the Capital Builder, the last 13 years track record that we have, our beta has essentially been in the range of 0.85 to 0.9, and we have an alpha generation of at least 20 to 25% on a compounded basis over this last 13 years, right? So clearly the strategy has played out well, and because of I would say a relatively low beta and a higher alpha, the risk adjusted returns are actually extremely superior across most of the parameters, and even compared to most of the other pure group comparisons. So I think that's as far as the Capital Builder is concerned. And again, the trick of the trade over there has been that we have been extremely focused on just doing long-term investing, and when you want to do that long-term investing, it is very critical that we build into, or rather we construct a portfolio where we believe that we are, you know, we would like to own them for at least 2, 3, 5, 7, 10 years. And even today, I think nearly 70% of our portfolio has now almost 7 to 12 years of our vintage. So which shows our confidence in the businesses that we own, and the construct of the portfolio also is very much towards the secular kind of businesses. So like you were mentioning about the sectors, so we have a fairly decent position in the financial services, and within the financial services we prefer the private owned businesses. We also have decent allocation to pharmaceuticals, overall healthcare basically, and again we've been very selective over there. We've been investing in companies which have very high domain expertise as far as their R&D capabilities are concerned. The third big sector where we are fairly positive is in terms of the automobiles. So again there we believe that thanks to the India's demography, which is the young aspirational, which I think is the one of the most lethal combinations for the consumerism growth that I am looking forward to. So I think that is where we are very well positioned. And of course, then we will have certain discretionary consumption businesses, whether it's your in some of these new age businesses, whether it's your food delivery, quick commerce, logistics. So this is how we are very much positioned in our capital builder.
Perfect. And the final and the philosophy question that I always ask you, but how would you sum up your investment philosophy in these times of war?
No, I think there are only two things which are very, I would say, which are permanent about equity markets, right? One is that they always go up in the long term, and second is they go up and down both in the short to medium term, right? So it is, as I said, that as an investor we have to be optimist, saying that over a long term, which is about 3, 5, 7, 10 years, it's going to be good growth. And over the near to medium term, this markets going up and down is what we need to capitalize, and that is what will help us generate an extra alpha.
As always, conversations like these remind us that while markets may move through phases of uncertainty, volatility, and a change, a disciplined and long-term approach to investing remains constant. Periods of global disruption often test investor conviction, but they also reinforce the importance of experience, research, and a steady investment framework, qualities that become even more valuable when the environment is less predictable. It is reassuring to hear how portfolios are being positioned with the clear focus on resilience while still staying aligned with long-term growth opportunities that continue to emerge across sectors and cycles. For investors, partners, and all those who follow the markets closely, perspectives from the fund manager's desk offer an important anchor in times when headlines can often create more noise than clarity. Sachin, thank you for sharing your insights with us, and thank you for joining us once again on the Fund Manager View. We look forward to continuing this conversation in the next edition.